After starting the week off with some pretty heavy selling, and then we had some inflation fears from these tariffs, the market finished the week with a huge reversal. Traders are asking, is this a bounce? Is this the start of a bullish comeback, or is this going to be kind of like a dead cat bounce? Here, the S&P 500 today jumped nearly 2%. Tech ripped higher today. Gold kept going up, which is probably not the best thing. Over $3,200. But here's a twist. This all came after China hiked up their rates. And consumer sentiment dropped down to strongly low levels. Producer price index was sharply below expectations. So why is Wall Street rallying in the face of not just a deepening trade war, but like significantly worsening economic data? So I'm going to break down the technical, that candlestick signal that kind of is flashing a bullish reversal pattern right now. It's a very, very strong pattern. We'll break that down. We'll talk about this PPI drop and how that's going to impact Fed expectations. And then we'll also talk about what all this means for positioning, from sector rotation, as always, to our sentiment and everything that we look at. So if you're looking for some clarity in the midst of all this chaos, this is your playbook for the next few days, few trading sessions. So let's go ahead and get started. Today is Friday, April the 11th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us in our blog, make sure you sign up for our daily Market Outlook email here. Click on Sign Me Up. You can also get notified when these posts are posted by clicking on subscribe, or come down to the bottom. It's easier maybe to click on this bell. Come over here, click on the Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. Come down to the bottom, click this heart. It opens up a new tab where you can like today's Market Outlook tweet. Click on this thumbs up. It opens up another new tab. You can like today's Facebook post. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. As I mentioned, we started the week off, very significantly lower, finishing last week on a big down move, and then starting this week off with a huge range. What is a 411 point range, both up and down, and then a big drop here from after gapping up, a big intraday drop on Tuesday before exploding higher on Wednesday. And so setting the low point of the week on Monday, but setting the high point of the week on Wednesday, and finishing the week a lot closer to the high. Pretty significant range too for the week, finishing the week. The problem is, though, because of yesterday and because we're not, we didn't build on yesterday's high point, your near-term line did not get into the upper reversal zone. So that's bullish territory. So if we're going to be bullish, that's a problem. The intermediate line has crossed above market sentiment. That's a very, very good step. So there's after, remember how we talked about on Wednesday, how great of a short-term pattern we had. We didn't really follow through with that yesterday, but now, today, that's a pretty good intermediate pattern to have the intermediate line crossing above market sentiment. The problem is, again, it would have been better if the near-term line was up in the reversal zone today. Then we'd feel really darn confident at considering Wednesday's pattern, and then getting the near-term line above 80 by today with the intermediate line crossing. That would have been outstanding. But the fact that the near-term line peaked below 80, we saw this is what a bearish peak looks like. You get a lower high point, you end up with a lower low. I don't think we're going to a lower low here, but I do think that we're going to get a near-term decline. We'll come down, and kind of test these lows a little bit here. So there's a possibility of that being the case. We're obviously still below the 2.5% mark, below the moving average. We're almost 4% below, so we're not out of the woods yet from that perspective. Let's take a look at the weekly version of the market forecast, and this is where that pattern's I'm talking about. That's a piercing line pattern where you get a significant candle to the downside with a big body, and then we gap down to open up the candle, in this case to the week, and then we rally up and finish at least midway up that body, if not more, right, above the midpoint of the body. Very, very good pattern right there. That's if we're as bearish as we were, if we're going to have any kind of reversal pattern, in this case a 2-day reversal pattern, 2-period reversal pattern, this is about as good of a pattern as we could get. Absent an engulfing pattern, but absent that, this is about as good as we can get. Piercing line. The near-term line is potentially crossing back up above the intermediate line. They're both between the reversal zones, so that's a big deal. So yeah, we might get a little bit of a reprieve here for a while, getting the markets to kind of rally up. I mean, we still have dark pink shading and a red line. We're still, well below the 5% or the 2.5% mark below the moving average. 5% here. Let me move this back to 5%. Now that we are back above the 10% mark that I had mentioned earlier in the week was so extreme. So we're back up above that. But we're not back above the 5% mark, which, remember, can act as a support when you're not going into correction. But we got a bull tag. We built on it to the downside. So we're not out of the woods, right? We're not like reversing now up to the upside, but at least we're reversing enough that I think we're done with the downside, at least in the short term here. Let's go back and look at some of the other indexes. So we'll come here to the Nasdaq. Came really close to an engulfing pattern. The intermediate line crossing above market sentiment, the short-term sentiment falling just shy, the momentum line down but not oversold. We got the light green shading. We don't have the yellow line yet, which would be that bear pattern. Looking at the Dow Jones Industrial Average, you see again finishing near the highs of the week. Intermediate line almost crossing above market sentiment. The short-term sentiment stopping short of getting in the reversal zone. Momentum line down, but to neutral levels. So I mean, this is like when you're really volatile, everything looks the same. You stop getting a whole lot of diversity, and everything ends up looking the same. The Russell did not quite finish near the highs, kind of more in the middle point of Wednesday's range. The near-term line did not get up to the 80th percentile. It's now back down below the 60th. So here's day one. So day two would get us below 20, and we'll see if that ends up being the case on Monday or not. The intermediate line has crossed above market sentiment, but they're both below the reversal zone, so not as significant of a cross, but still, bullish. Still a bullish pattern, and you're crossing above the 20th percentile, so you have the light green shading there as well, but still significantly down below the 30-day moving average. Let's take a look at some of these other weekly charts that we like to look at here. So big body, right? Big, huge candle. We talked about that earlier in the week. We have the death cross, so the PPO is negative. But here is what we look at, right? You can see next week's body is going to open up right around this 53.44 range. Well, we're trading at 53.63 to finish the week. So, at the worst, the candle next week is going to be a transition candle. So that's a really, really good sign for the markets too. Again, depending upon what kind of transition ends up being, are we going to get a reversal or not? That remains to be seen. But at least it's enough of a transition to halt the downward momentum to the downside. So very good sign there. And then when you look at the whole, like we like to look at the whole moving average here, on the weekly basis, again, we are still below the 20-week. That's not changing. The PPO is still down. The size of the candle is pretty bearish. The parabolic SARs are easily above there. We haven't turned the 200-week red yet, right? So the 200-week whole moving average, turns red really late in the process. So it has not turned. We're still easily below it, right? In fact, last week we got down 14.5% below it, which is a pretty darn low level, considering that's about where it was a few weeks after being that low that it turned red back in 2022. So, we're not, it's the parabolic SARs are easily above, and we got the big size of the candles here, bigger, the biggest since that washout phase in June of 2022. So, we are, I would say that right now we are in the washout phase of this correction. I mentioned, I brought this up here when you look at the rate of change. And you can see kind of the decline we've had, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Kind of a 10-day decline here, but But you can kind of see, over 26 days, which is what, this is based off of the Ichimoku cloud. When we look at that red line on the Ichimoku cloud. But when you get to a certain point, right, you can see you get a washout move, and then in this case, this happened in June of 2022, and then we retested it again. And you saw that in 2018. We had a washout. We retested a little bit. It wasn't very much, but we retested a little bit there. In 15 and 16, we had a washout move. We retested it there. In 2011, we had a washout move. We retested it with a lot less momentum there. 2010, same thing. Big washout move here. You can see that's where we got all the way down below 10%. Then we retested it a couple times before rising up. And then the 2007 move, you can see we didn't have as big of a washout stage in late 2007, as little bit as one as we could. It's actually right here. This was the washout stage there. We got below the minus 10% mark on this 26-day rate of change, and then we retested. So again, we got below the 10% mark here on this washout move. And there's most likely, just like in a bear market, when you're in the sways of a bear market at the lows, when you're in the washout phase of the bear market, you retest it, right? And that usually ends up being the last stage of the bear market. You also have that in corrections. You have the washout move, you retest it, and then we bounce up. And so I think we're washing out now, and we're going to be starting after getting a green tag, which, we're at that 9.5% green tag here. After this green tag is over, once we start going back down and retesting that low, then we'll get another red tag, probably around the 10% mark towards these lows down here. And then we make our stage 4 correction bounce up to the upside, because at that point you'll have oscillators starting to roll over. If you look at the 3 green arrow chart, you can see we still got significant resistance up here, up to about the 550, 559 level in that area. Very, very significant resistance. But if I look at the weekly chart here, 559 is like right in this area. So it's not very far at all. And we haven't even had it's hard to retest to have that stage 4 when the moving averages aren't really rolling over, right? They're not, at least they're not going down. They're starting to roll over, but they're not really going down there, and that's kind of what you need, because that's what you need to retest, right? You need to come up against them on a downward mode and see if they will bounce back up. And this was actually right here, the retest, and eventually we broke and rallied through to the upside. And if you look at 2007 to see what it looks like when you fail, we drop, we retest up to these moving averages that are now falling, and then we fail, right? And so that's kind of what, like, we are early on in the process. We still so early that we haven't even got those moving averages rolling over yet, so that we can bounce up to them and fail. So I think, again, this is the washout stage. I think we're getting a little bit of a reversal. I don't think it's going to lead to a strong move to the upside, but it'll lead maybe to some strength here this week. Not as much. Like, there'll be some ups and downs this week, but we'll probably get some kind of figuring out this short-term top before we then roll over as we go through the rest of earnings season and look to test the recent lows, not with the same speed to the downside as what we just had the last week or so. Be more grinding, more methodical on its way down to retesting those lows, and then touching the 200-week moving average like it did on this retest, and then we see, okay, after when we bounce up, are we going to fail or not? Are we going to go up to new highs? In which case we get really, really good returns, or if we fail, then that's what we saw in 2007 or 2008. Let's take a look here at some of these other oscillators, which have been so bearish, right? They're still relatively bearish, still above 25 on the negative indicator, still below 20 on the positive. If I look at the RSI and the CCI, they're not bullish. They're not strongly bearish, but they're not bullish either. If I take a look at the Ichimoku cloud. Where is that? There it is. If I look at the Ichimoku, we're way below the cloud, and the cloud's pink, so we're not, like, we are above the blue line, but not above it enough to get, you know, the trend to be done, this mature bullish trend that we're done. So I think we, you know, we're bullish enough to get a green tag, as we saw on Wednesday, but you have to be here a little bit longer if we're going to break what is a mature bearish trend. I don't necessarily think we're going to break that before we retest those lows. And again, whether we go to a lower low or not, that doesn't matter. It might go a little bit lower. Most likely we'll end up probably around the 5,000 range, plus or minus a few points. And then that's where we'll get, you know, our next rally up to the upside. The beginnings of that stage 4 correction bounce back up to the upside. If we take a look now at today's range, and that's kind of the other thing about today. Nice, good day, but the range really tapered off. Very, very small range, below average, right? After getting significantly above average ranges here this week, we have a below average range, and we have below average volume, at least below the 1.5 time average that we've been above every day for the past, 6 trading sessions. So big drop in volume, big drop in range. And again, the more those drop, the more bullish we can be. So if we're going to sustain the bullishness, but I even think when we retest those lows, they'll continue to drop too because they're so extreme. Again, setting in the low point of the correction, right? The correction low that we could ultimately, odds are that we could ultimately bounce off of to new highs and get some really good returns, and away we go in that perspective. Let's take a look at the VIX. And you can see a big drop in the VIX. The VVIX is still relatively high, but the VIX, big drop there, down below 40 now, down to the 110% mark. Good move on the volatility index. Not out of the woods, right? Not good enough to be, okay, this move on volatility, the upside's done. I don't think it's done, but at least it's not so exacerbated to the, you know, to the upside of volatility, which means puts a lot of pressure on risk appetite trades when we're so volatile. So I like the move. It's not, we're not to the great spot, but we're in a much better spot than where we were earlier in the week. So I like the move down here to the downside, setting up for more downside move going into next week. Even if we just kind of moderate up here without a break below the 100% mark or a break below 20, but if we can just moderate in that area, you know, that would be a good mission accomplished for the markets right now. All right, now let's take a look at what's driving this price action. Again, gold is unstoppable. It just continues to be, but main reason gold is unstoppable is because the dollar is continuing to go lower. In fact, over the past 3 months, the only 3 asset classes that are doing worse than the dollar are U.S. equities. Like anything U.S. related, excuse me, U.S. related is getting like beat up right now. So let's take a look at it here. Let's bring up just today first, and then we'll go for the whole week. But this is today. Emerging markets, developed markets, just killing everything. 2.5%, 3% for emerging markets. A lot of that due to this weakness in the dollar. Look at this drop that we had here in the dollar index. Let me pull up the market forecast. Here we go. Finishing the day below 100, right? Finishing at 52-week lows. Got a cluster, right? We got an oversold cluster again on it. The intermediate line is back in the reversal. This cluster, unlike these others, has a market sentiment line down there. So kind of like this cluster over here. So, you know, do we have a short-term low point? Well, that remains to be seen. You know, how much longer? If I were to take a look, I mean, this is a pretty decent drop here on the dollar. Here, let me bring up dollar index. So, you know, what, over 1, 2, 3, 4, 5, 6, 7 days from this low to that 7-day decline. So here, let's bring up 7 days. So that kind of, when this really started, so 1, 2, 3, 4, 5, 6, 7, yeah, 7 days. So we're down nearly 4%. We were down 4% over here on that 7-day decline, almost 4%. It's a pretty significant drop. If you look at, you know, how many times we've had this kind of drop in 2022, we had this kind of drop here at the end when we were coming up off of the October low point of that correction. Other than that, again, you can see it's rare for us to get down to 4%. We had to go all the way back to 2008 to have this kind of drop in the dollar. So big time drop in the dollar. If you take a look at the euro, you can see the rally that it's been on. Big move up to the upside. In fact, if you look at the weekly chart on the euro, you can see, from 1, 2, 3, 4, 5, 6 weeks. So let's go to a 6-week chart here now for the euro. Relative to the dollar, of course, which is the biggest component of the dollar index, is the euro in there. Up almost 10% over this 6-week time frame. So again, zoom out for some perspective. 2010 was the last time we had this big of a jump in 6 weeks on the euro US dollar, and then over here during the bear market 2008, like this is the biggest jump we've had. We're breaking up above old highs. Like we are making a significant move to the upside on the euro and to the downside on the dollar. That in the past, we did a big long study on this in our portfolio management class today at Market Scholars. Like when the euro takes off, that generally has led to weakness and volatility in the U.S. markets. It's when the euro falls is when the markets have been as bullish as they've been. 2021, obviously 2022 is a little unique with that rate cut, but that's not like usually we don't want the dollar to be dropping as significantly as it's starting to drop now. We saw that kind of in the 80s. We looked at the 80s, where we also had a big run in the euro relative to the dollar. The dollar had a big run relative to the euro. We had a really good returns until it peaked, and then we had some volatility in 87 and 1990 and 1991 and going in 1994. And so that that's the kind of, like, we don't want that kind of volatility. But if we're making a difference here, if we're making a new run, a new change, to where we're now long-term bearish on the dollar, long-term bullish, and you can see like there's plenty of downside for the dollar. Like we dropped below 100, but like recent lows, like in the past like decade plus, is around 90. In fact, we were at 90 in 2021. So I mean, that's not out of the question. In 2014, before the dollar really took off, I remember, again, the U.S. equities really took off too. It was down to 80. So getting to 90, getting to 80 is not, or even to 70 eventually, as you can see, as we got down there in 2008. It's not out of the realm of possibility to see that kind of weakness in the dollar, and that would be... I don't think that would be the best thing for equities over the long term. I think it would show the potential for weakness and volatility, more volatility. Doesn't mean the markets are going to go down every day. It doesn't mean it's going to go down every week. There's going to be ups and downs, but there'll be a lot more downs than what we've been accustomed to over the last little bit, where we get a little correction and we bounce right back up. But we're starting to pick up the corrections. We had a correction in 2022. We're getting another correction now in 2025. What will this correction turn into? That might be a sign, because based off of what we're seeing here. So that's impacting gold. As you saw, gold is doing very well, and gold really took off to the upside. It's really going parabolic. We do have to keep in mind, though, that when you look at gold relative to U.S. equities, gold is just starting to take off. So if I look at it over here and look at SPX relative to gold, let's see here. I think it needs to be $SPX. There we go. So the S&P 500 relative to gold, look at that big breakdown in the S&P, again, relative to the gold. After peaking in 2011, Like that's how far. Like gold is way higher than it was in 2011. It's way higher than it was in 2020. We are just approaching that 2020 low, the COVID low, and we've got a long ways to go before we reach the what would actually be the peak here in gold relative to the S&P 500. So we'll do it this way. There we go. We got a long ways to go until we hit that peak up there. So as parabolic as it is, and it is parabolic, and I think we're going to ultimately find a peak here on at least in the short term, intermediate term on gold, which means we'll get an intermediate low at least on the dollar. I don't, and we pull back on this ratio. I don't think that's. I think we're in a new regime change now for this, to where we're now moving up to the upside, just like we saw in 2006 and 2007, where gold was outperforming the S&P, and this is a negative correlation typically. So if gold is outperforming the S&P, it means that there's volatility and weakness for the S&P, just like we saw there talking about that relationship with the dollar. All right, so and you saw the international equities and how they're doing. If I were to zoom out to the week, the beginning of the week, again, you can see gold ended up pretty decent, but so did the Qs. The Qs ended up rallying up 7%. Small cap stocks did not end up rallying. So that broadening trade, how people talk about, oh, we're going to want to take advantage of small cap. No, if we're falling because of the Qs, and we're going to bounce because of the Qs. But look at the big move down in the dollar for the week, and especially look at the big move down for TLT, which means that bond yields had a tremendous jump to the upside this week. If you take a look at it here, look at that rally there. Big time move. We went from 3.98% last Friday to now we're at 4.49%. So a 50 basis point jump during a week where the odds of interest rate cuts are ramping back up again. You can see if I go to the interest rate cut odds, and obviously we're not going to get a cut in May. I don't think we're only a month away from the next Fed meeting, and it is not a meeting where they issue projections, and they don't like to start a new cycle when they don't. So we're probably not going to get a cut in May. Right now there's a 40% chance of a cut, 60% chance that we won't. But if you look at June here, it's not as high as it was, but you still have about a 60% chance, 60 or 70% chance of a cut in June. Now it was 85 yesterday, and a week ago it was at 95%. That's what that 50 basis points have done. It's really hampered the rate cut path. It's still there. The 2-year yield, you can see, it's up. It was up 12 basis points today. It's at 4%. So it's still pricing in a cut at some point in time. And the yield spread, as you can see here, has jumped up big time this week. And remember, the market does not want this to go up to 100, 200 basis points, right? That's what happens when the Fed's cutting rates. That's what happens during bear markets, right? So or recessions. The market does not want this yield spread. We want a peak. We want to get back down towards zero. That's what bullishness comes. That means we're not cutting rates, or maybe we had one or two like mid-cycle adjustment, but that's it, right? But if the 10-year yield's rising and the short-term rates aren't, usually it's because the Fed's cutting rates that brings that spread up. In this case, it's been the 10-year yield rising, and the short-term has not been rising as much. And then again, eventually, if and when the Fed does start cutting rates, which it looks like as of right now is June, then it would really take off up to the upside, as the short-term rates typically fall faster. And that's kind of the shoe that hasn't, once that shoe falls, then we're not going to be in just a correction anymore. This yield curve, once we get these to start falling, as of right now, it's not a concern, right? Because you can see the 10-year yield, this one right here, is up above most of these lines. It's sitting kind of right at there's the 3-month is the red line. So they're sitting right on top of each other. The 2-year is a little bit lower, as we talked about. So there is about a 50 basis point gap there. You can see these long-term rates, the 30 and the 20-year, are still up high. So, there was a time where these long-term rates were below the short-term rates. Now they've risen to be up above it, but we still haven't gotten the turn, right? The turn back down to the downside. And when that happens, because the Fed is cutting rates, then that yield spread, as you can see here, the yield spread takes off. And again, getting up to 150, 200 basis points means that, we are in a bear market / recession, and an extended cut cycle. And considering that, we've been kind of for decades getting lower highs and lower lows on these cut cycles, well, this last hike cycle was higher than the previous hike cycle that we had pre-2019 into COVID, right? So we have higher highs on an interest rate basis. So probably when we drop, we'll end up with higher lows, which means we won't go back down to the 0% overnight rate. Let's take a look at the breadth and the sentiment. So give me 1 second to bring up the McClellan oscillator. Again, still negative, so we're still below minus 500 down there. Obviously, the number of stocks above, the 50-day moving average and 200-day moving averages, which were so extreme earlier in the week. We talked about that, setting the stage for that Wednesday bounce. Here's your net new highs and lows. Back, still negative, but above their average. Here's the number of stocks above the 50-day moving average, back to above 100. So good, right? That's the 20% mark, and that's a good sign. At least getting back up above there. So we're not so extreme. We're almost back above 150, which is the 30% mark. This is kind of, it's like the RSI. That 30% mark is kind of a bigger deal on this one than it is on the other stocks. So as a result, your big ratio, which spiked up this week finally up to 3, is really coming down hard. And again, coming down below that average is a good sign. That's a good little bullish sign there. So we're not below the average yet, and we could bounce right back up. You can see a lot of times during the retest, we get a bounce back up on this. And so I think that's still coming, right? We're still going to get, a little bit of a bounce. My expectation is that on the zigzag chart, one of two things. I think that we're either going to continue to build this up into this area right here, this 55.20 area-ish, plus or minus a little bit. So we kind of get back up into that 55.20. So we'll either do that early next week, or if we get some weakness early next week, it'll be kind of late in the week, the week after, so after options expiration. Either one, but we're going to eventually peak here, and then I think we ultimately retest this low point down here with another red tag that will be closer to that 10% mark. So maybe like an 8 or 9% drop. So there's a washout and then our retest, and then we'll end up getting the bounce up. So that's kind of my thought. So I think here over this next week, I think we still kind of go up and down, potentially with the red tag in there, because all you got to do is get the 5%. But even if we don't, we kind of go back up here and then hit a ceiling in this 55.20 area with that green tag, either a new green tag or this one getting up to like say 10, 11% before we roll back over to the downside. And as we continue to run higher, you would expect that you'll continue to see some strength in the sectors that were so weak. In this case, technology. And industrials and financials actually have had a really good end of the week. It was consumer discretionary early, but it's lagged behind. And you can see industrials has kind of picked up. But technology, that's your big key. That's the big mover. So the more it outperforms, it will outperform to the upside, and it will most likely underperform again when we retest to the downside. So keep that in mind. We're not changing directions into like small cap stocks and energy and things like that. Like if we were going to rally, and we are, right? We're gonna finish this green tag out. We're gonna get another one after a retest. During those rallies, expect that the stocks that the bigger stocks in the index will be the ones that lead us up higher, and they're actually all not showing bad signs. In fact, when you look at the Mag 7, they're all kind of at the bear tag level, right? They're all light green shading. They're all trading around the moving average. Some of them actually did get bear tags. Netflix, Microsoft, Broadcom, NVIDIA have all gotten bear tags. So the light green shading, Tesla as well, light green shading in the yellow line. So we're all in kind of that bear tag range where will either kind of build on this break above the moving average and build on that, or bounce back down and retest. And that's kind of, again, like I said, that's my expectation here. All right, and that brings us to our trade idea for today. It's actually on Charles Schwab, and you can see we got a bear tag. We got a little bit of a bounce up. We got the bear tag there. Earnings coming up. Intermediate line coming out of the reversal zone, or out of bearish territory, but not quite above the chart's midpoint or the market sentiment yet. Short-term sentiment is relatively bearish or bullish there. You can see on the weekly chart. Schwab. Try this again. Got a green arrow on the weekly chart. We don't have the death cross. We're got big range. So we're kind of stalling here. If you look at the 3 green arrow chart, right around the point of control, you got a big volume node up on top. You got some support down here at the bottom. You can pretty much have the range of the year-to-date range set with the high up here and the low down there. And you notice that's where my break-evens are on this trade. Is you pretty much guess. So we're looking at a iron condor to stay inside of that range. Both lines on the DMI are below 25, or between 25 and 20. If you look at the RSI and the CCI, they're also at neutral levels, right near the chart midpoints on both of them. Looking at the Ichimoku cloud, the trend is there's no trend at all. We had a bearish trend, it's not there. We're still below the clouds. We're not bullish. But we're not bearish anymore at all either. And then finally looking at your Bollinger bandwidth and your Keltner channels, the bands are peaking and starting to roll over right in the middle of the bandwidth. The momentum, the bands are outside of the Keltner channels, but the momentum appears to have bottomed out and is rolling back up. And so looks like we have a good opportunity to kind of stay around the point of control and stay inside of this range. For the at least until May expiration through that earnings. So I decided to take advantage of the earnings and get some good premium. So I went a little bit lower on the put side to get that break even down to that low point. And again, I'm not as worried about upside risk right now. So I went to the 30 delta on the upside. So skewed it just a little bit to the downside here to give myself more room to work with down here. And so far so good. Came off the highs a little bit during the Market Outlook Live. So we got a little bit of a gain, but yeah, so there's my break-evens at the high of the year and at the low of the year. And as long as we stay in that range, if we break out of either one of them, then we're going to want to make a directional trade. So that would be a good opportunity to get out of this trade and look at something else. So that's, ends up being a good trade if we don't. And then we just stay kind of right around the center of gravity here, which is the point of control inside of the value area. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. We'll see you all on Monday.